supercharge your understanding. They're not going to make you faster at learning it, okay? The only thing they're doing is trying to capitalize on a market that's huge right now, which is TikTok mentality. You know, 10-second, 15-second, 30-second time span of attention span. And I have no patience for anyone, zero patience for anyone as a student that thinks like that. I broom them quickly. I get them out of my face. I don't want to have any interaction with them because you're absolutely lazy. You're absolutely lazy. You want it easy, you want it real fast, and you have unrealistic expectations. And anyone that has common sense will tell you that that is someone that will not be successful. Period. End of story. If you don't want to warm up to the idea of how to do this properly and understand, really understand, that's what mentorship is, understanding how you're going to most likely interact with the marketplace, what's a reasonable response to you for you feeling this way or that way should the market produce an outcome that was either favorable or not favorable for you. How are you going to interact with? Let's say the first time you sit down and you try to test something and it takes off and runs like 150 handles in the NASDAQ. What's that going to feel like for you? You're going to feel ecstatic. You're going to be excited. And you're going to feel like, wow, this is a whole lot easier than I thought. And that's wrong. But see, that's the problem with these 20-year-olds that teach. They want you to have the emotional stimuli because that emotional stimuli gives you a rush. It's dopamine. It gives you that physical, feel-good butterfly moment that does not last. It will not last. 10 minutes later, you're not buzzing by that right call that you made, that demo trade that you made, or that you just passed your combine. You all think that I got to get my combine passed and then I can start trading on an account where I can make profitable trades. So you're willing to do everything and anything just to gamble to get it passed. And then once you get there, you think it's going to be easy when it becomes extremely much more difficult because now you don't want to lose that past funded account. And every candlestick looks like a foreign language to you. Even if you understand certain elements of reading price action, it will look completely different. You won't feel comfortable pushing a button because now you're thinking, if I get in right here, what if it goes down to here? Or what if it goes to this high here? Where do I put my stop loss? I don't want to get stopped out, but I got to use a stop. And see, what are you doing? You're trying to protect yourself from a losing trade because that losing trade, even if it's small in denomination, if it's small in amount of really, dollar risk, the lasting impact and the depths of how far it digs into your backside, it's monstrous because you're creating a demon. You're manifesting your worst adversary because you didn't do everything that I'm suggesting as a starting point right now. It prepares you for this. What do you think basic training is for when people go to the military? It's to get the person physically fit, to get them introduced to constant disruption, constant mental fatigue, so that way they're not shell shocked when they get out on the battlefield and freeze up. They're used to being treated like trash, worked out, fatigued, run them, work them hard, talk down to them. There's no hope. There's no hope while you're in basic training. Well, this is what this is like here. This is basic training. I'm not going to sugarcoat it for you millennials. I'm not going to be nice to you and say, honey, it's going to be okay. Let me hold you close and coddle you. ICT's got you, baby. ICT's got you. It's okay. It's okay. That's not what this is. You want to learn how to trade? You want to be consistently profitable? ICT's not going to be rubbing your shoulders for you, okay, and powdering your ass when the market's in front of you and you're ready to take a trade and it's all on you. I'm not going to be there. You have to be able to do this on your own. You have to be able to do this absolutely isolated. You have to be an island unto yourself. When everybody else is on social media saying they want to do one thing or the other, and you look at your model saying, I don't see that, you got to be completely comfortable with that. Not for the basis of just simply being a contrarian alone, but for the basis of, okay, I understand what I'm looking for, and this is just further confirmation that the herd of sheep out there are expecting this. So I know I have a lead pipe sense trade now because every time Dick and Harry out there is wanting the market to go to this level or this direction. And here I am sitting confidently waiting for a setup that's completely diametrically opposed to what they expect. That's one of the things that I take great comfort in watching live streamers because sometimes they get it right, and that's fine. Most of the time, they aren't. And the times that I'm looking for something before I even start looking at their live stream, if it's opposed to what I'm expecting, it's a dead deal. It's over. I'm over the target. I know I'm right, and that's not the goal here. But I know I'm going to use the maximum leverage. Okay, so whatever my maximum leverage would be for that individual asset class or that market, I would be comfortable doing that. But initially, when you first want to do this, you want to be trading. Listen, folks, I know this is going to be unpopular, but you want to be trading with a micro. Just because that funded account says I can trade 5 contracts of the NASDAQ with $3,000 of a cushion, I want you to hear this, okay? And I mean this sincerely, and I'm not trying to be funny about it, but if you're trading more than one contract of a micro with 3,000 cushion and you're not consistently profitable and you don't know what you're doing, you're absolutely gambling, and gamblers don't last long. You can gamble. There's a lot of people over the years with all these funded account companies. I've had students that's done this too. Paid mentorship students that have gone through it, they've passed combines, they got paid out, and then they lost it. And then it completely undid them. And they can't get it back, and he can't pass another combine. Why? What happened? Did the concept stop working? Did they change the algorithm? No. Now they have mental baggage. They have scar tissue. And now the lessons I taught in those Twitter spaces over the past couple of years, and no, I'm not on Twitter, the the depths of where I was trying to take you, a lot of you haven't gone to those places yet in your trading. So the lessons just went right over your head. It doesn't apply to me. But for anyone that has actually tried to trade with real money or had a live account or a funded account and has taken withdrawals from the marketplace and then they lost it, now those Twitter spaces, now those talking points, those lectures like we're doing right here, they are much more meaningful and they're impactful and they are helpful. But when you have a millennial that wants to go out here and say, "Now look, man, this guy's full of crap. You know, he's talking too much. He ain't done anything. He ain't pushing any buttons. How am I going to learn from somebody like that? I need somebody who's going to show me what to do so I can copy them. That's me learning." No, that's not you learning. That's how you grow codependent. And I don't want any of you to be codependent. I want you to be able to walk out there and say, this is what I see potentially unfolding in the marketplace today. So I'm going to build an idea on how the market may, in fact, set this up. And if I understand that this is where it's likely to go, and what I mean by that is, where's the draw on liquidity? Where's the market likely to go? You know, what are we looking for in terms of potential expectations and where the market could trade to? And that could be something like this. We have relative equal highs right here, okay? Very simple, smooth price level. The market's gone down a lot, several thousand handles, okay? We had a huge gap, new week opening gap here. So where we settled on Friday and where we opened on Sunday at 6 o'clock last night, Eastern time in the States, that new week opening gap, that's a draw on liquidity. But we don't need it to trade all the way up to there. So where is the low-hanging fruit objectives for just short-term bias? This is what I'm teaching you, Caleb, initially. I want you to think about where the market could draw to right now, where it could go to next. And what that does is it gives you something to focus on. And it also gives you a way of measuring every individual candle's formation and what your expectation is as it's forming and what the next candles should do and how they behave and what it feels like for you when you do this. Because whether you want to admit it or not, when you're first starting, The majority of your time is going to be spent in uncertainty, in times of confusion. It's going to be fearful. It's going to be, well, it's going to feel very anxious. You'll feel anxious. You may even start feeling body symptoms of tinglingness, lightheadedness, feel like you're going to get sick, and you may still only be in a demo because what you're doing is you're elevating the outcome to a level that is not expected. You don't need to put that much pressure on you. In fact, if that's how you're thinking, it's normal for you to feel that way when you first start trading with a real account. That's a normal thing, but there's no way around it. There's no way around that first trade with real money. That fear and that anxiety is something you have to engage it, and that's why I say as soon as you get a live account, first thing you should do is flip a quarter, lowest leverage. If it's tails, you buy it. If it's heads, you sell short, or vice versa. And you do the smallest leverage and put a 15-point stop on it, and just let it happen to you, and break the ice and let it go. But see, a lot of you, if not all of you, you want your first trade to be a winner because you think it's a jinx. Okay, it's somehow an invitation for failure if your first trade with your real account loses money. Like that somehow defines your entire career. It doesn't. It's just one transaction. But the way you overcome that is spending time without pushing a button, studying where price can go, and that's this. We have this short-term high here, post 830, meaning after we had 830, right here we have 836. So the market went below these relative equal lows. So any liquidity below that, they disrupted that and then took it above this short-term high. Took it above this short-term high and traded right inside this fair value gap right there. So when you're watching price, Caleb, you're looking for how the market maneuvers and trades and books between obvious price levels with old highs, old lows, and inefficiencies. They're the only two things you're worried about. You're not trying to predict a direction on the day. You're not trying to be right about 50 handle runs. You're just studying, observing. Okay? This down close candle here, after taking out the liquidity, and then we have displacement here. Displacement is where the market runs against a pre-session, pre-day, pre-trend or price swing direction. In other words, it's a counter move to what's already been in play. So the market has dropped here, and then we moved aggressively above this short-term high. This high being traded above there, we go back down to this down close candle. That down close candle is a order block. We have displacement. It took liquidity, and the market has been one directional. Now, what makes that an order block specifically is has happened post 830. Now, it could have formed right at 830 because 830, the algorithm will start spooling for liquidity or inefficiencies, one or the other. Now, in the beginning, you're going to want to know, because you're probably asking right now, can you just tell us what is it going to reach for? Is it going to go for an old high or old low, or is it going to go for a fair value gap above or below? Both. It's going to go for both. Is that complicated? No. Now, to further strip away the complication you're adding to it right now, you're bringing all these things. But what if it's a COT? I didn't say anything about a COT. Yeah, but what happens if the... Did I say anything about those things that you're thinking right now? No, they're not important. The only thing we're doing is we're sitting down at a time when the market is predisposed. That means it's most likely going to do this. And it will do it unless some unexpected event where manual intervention steps in, and you don't know and I don't know when that's going to happen. What does it look like when the market just starts going and it starts going one direction and it doesn't stop? It doesn't go up a little bit, come back a little bit, up a little bit, come back a little bit. That's That's market standard delivery. Intervention is think like FOMC, think like CPI, think like non farm payroll, where if you're wrong, if you're offside, right when it hits the market, you're dead. That's what manual intervention looks like. They're many times untradeable. It takes off so fast. You reasonably, no, not reasonably. You're it's unreasonable for you to assume that you can trade that once it starts, because you're literally chasing the wind, and you're never going to catch it. You're just going to frustrate yourself and get placed very poorly, and you're going to be in a trade that's going to be highly anxious and stressful. And that's not trading, that's gambling. Okay. So when we look at individual setups like this, you want to sit down in front of the marketplace right before 8:30. Okay. Preferably 8 o'clock. And you want to look at where the highs and the lows are in deference to the 1 minute chart and the 15-minute time frame. So I'm going to change this chart over here to 15. So here's what 15-minute looks like here. And if you look at where we came from, see this high at 7 o'clock in the morning? That's this high right there. See it on the right chart? So this chart, this larger chart here, is the 1 minute, and this is the 15-minute time frame. 15, 5, 1 minute. Those are your first three time frames to worry about. Okay, and I shouldn't say worry, because it's kind of like gives you a subconscious concern that you need to worry about it. You don't need to worry about it. But the levels and inefficiencies on the 15-minute time frame, the 5-minute time frame, and the 1 minute time frame. If you're brand new, you don't know how to trade ICT, you don't know how to trade price action, you don't know how to trade period, okay? You don't need any other time frame. Okay, you don't need anything else. You don't need a daily chart. You don't need an hourly chart. You don't need a 31-minute chart. You don't need a 17-minute chart. You don't need a 15-second chart. You don't need anything below a 1-minute chart. You don't need anything else to do what I'm going to teach you. Okay, this is what you're doing. You're studying price at specific times of the day. If you're not writing this part down, you're blowing it already. So between 8 o'clock and 8:30 in the morning, New York local time or Eastern Standard Time in the US. Everything I mentioned in terms of time, if it's the time that matches New York local time. So set a clock. If you have your smartphone, there's a way that you can pull up world time and put one in there for New York. And you'll always know what time ICT is saying to look for these things to happen, because they're never going to not be there. Write that down again, okay? And underline it. This is always, absolutely, without fail, it's never not going to do it. It's always, every single effing day, it's going to do this very thing. It's going to do it. It's going to absolutely do it, because there is an algorithm, and it does this to spur on emotional interest or tangible orders that are actually sitting out there. Real orders that are sitting above and below or inside of inefficiencies where the market needs to offer fair value to the marketplace. So what is it reaching for? It's reaching for old highs, old lows, and inefficiencies. That's the fair value gap. SIBI, BISI, that thing. So once we know that the market is likely to do these things, that's a characteristic. It's an algorithmic characteristic. You don't need anything else besides this element as a foundation to what you're trying to trade, and you can make all the money you'd ever want. I'm going to say that again in case you missed it. You're trying to find right now, you want the daily bias, and you want to be able to buy below the open and hold for the whole entire day. But are you really doing those things when you try to trade? No. Because as soon as you get 10 handles or 10 pips or whatever, you start struggling with holding on to the trade. You're paranoid that that winning trade that you just found out just fell into your lap. Oh my goodness, I'm winning. This is something new. I need to secure this. But then you're thinking, oh wait a minute, I'm supposed to be holding for the daily range, and now you're wrestling, and that becomes a real hard wrestling match, doesn't it? It makes you feel nauseous. And if anybody tries to talk to you, even if they love you, your spouse, your girlfriend, your boyfriend, your child, your dog comes over and nuzzles up next to you, any other time you're like, oh, this time, get away from me! Can't you see I'm trying to worry about this 10 pip handles move? The weight of the world is on my shoulders right now, and you're coming at me with this? You know what it means. You're stressing out. Why? Why would you have that response? Folks listening to headphones are like, oh man, this guy. You're awake now, aren't you? But that's the reality. That's what it's like. And you'll feel it if you've never been there. You'll feel it. But the reason why you feel that is because you don't know what you're doing. You haven't done this part long enough where you're completely desensitized to, okay, I'm doing this exercise to get comfortable with anticipating price moves. I'm getting comfortable with not knowing what it's going to do next candle, this candle, 5 candles from now. But I think it's going to draw to specific price levels. So if it clears that short-term low we talked about, what's it going to reach into? We have this inefficiency here. How long does it take to do that? And then you record, you screenshot this, and you say, okay, well, it took 1, 2, 3, 4, 5, 6 candles from this volume imbalance to run above this short-term high and get into this SIBI, which is a sell side imbalance, buy side inefficiency. A fair value gap that has a down close is a SIBI. Okay, a fair value gap that has a up close is a BISI, buy side imbalance, sell side inefficiency. So what you're doing is you're measuring, because you have zero baseline experience. You have no continuity in what it is you're reaching for, looking for in price action, and you study how long it took, and you record this many minutes. And you also are honestly going to record in your journal within the screenshot, like maybe over here or somewhere over here. You're going to record what it felt for you physically. Were you anxious? Did you second guess that it was going to run there? Did you feel excited the entire time? Were you impatient that you thought it should have moved there sooner and faster? Did certain candle formations cause you to doubt it? Did you have a point at which you thought that it was given another opportunity to trade to, or not trade to, but offer another entry, like say, for instance, if you wanted a pyramid. Pyramiding should not be part of your repertoire yet. That's something that you need to be doing maybe a year after trading with one contract. Oh, come on. You want to learn how to do it correctly, this is the way you do it. There's all kinds of time and opportunity for pyramided trades, but you first have to get good at trading with one micro contract. One micro contract. Because what that does is it removes, hopefully, this is the only thing you can do to fend off the greed and fear. You can't blow the account if you trade with one micro and you only take one trade a day. It's physically impossible for you to go out there on day one and blow the account. But see, that's what your subconscious is fearful of. I don't want to blow the account. I don't want to have a big losing trade. I don't want to go into big drawdown. Okay, that's easy. Don't over leverage your account and don't take more than one trade a day. But ICT nothing. If you want to be able to do it correctly, you have to do things with a process. There has to be a logic behind it. There has to be some measure of rule-based thinking, and then you have to adhere to that. If you don't want to adhere to rules, I promise you, you're going to lose, you're going to fail, and you're going to blame me, you're going to blame everybody else, you're going to blame the prop firm, you're going to blame the brokerage firm, you're going to blame everything but you. I know this because I did the same thing as a 20-year-old. I did the same thing numerous times. I have students that repeat the same thing. They've sent me hate mail years ago. Oh, you didn't teach me right, this, blah, blah, blah. And then later on, they went through it properly, and then they send me emails apologizing. It was a mistake on my part, ICT. I didn't listen. I went back and re-listened to it all, and I made all the mistakes you said I was going to make if I didn't listen and just plunged ahead and did what I wanted to do. Now I did it the right way. I listened to what you were expecting in terms of a properly mindset student that follows the rules and accepts the diversities initially that are normal. They're all normal growing pains. But see, you're trying to be the exception. You don't want it to happen to you. You think it's going to be candy bars and milkshakes and just everything's sweet and lovely and butterflies are going to come land on your hand and everything's kumbaya. No, 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 no. As soon as you push the button, you're asking the shark to take a leg off. You're asking that lion to take your face off. You're inviting it. That's what it is. As soon as you enter these markets, you've entered the jungle. You've entered the deep waters. And honey, everybody's hungry. And if you offer it up on a silver platter, they're going to take it and eat it. And you can't be upset about it. That's the the currency here. Yours or mine. Mine or yours. That's it. It doesn't matter how anybody else trades. It's are you liquidity right now? Are you liquidity? Because if you're liquidity, you're lunch. I go in and I'm looking for lunch. I'm looking for the liquidity. I'm looking for reasons why the market will trade to this level, why it could potentially trade to this level, but I don't need it to trade, for instance. This is the draw on liquidity. Draw on liquidity is just a initial reasonable assumption on our part to determine a directional move that could unfold. It does not mean and it does not define the absolute terminus to a price run or the be all end all target. In plainer terms, the market's probably going to keep moving until it gets to this level. It doesn't mean that it can't have retracements lower. It doesn't mean that it can't make a lower low than it's done here. Highly unlikely, but it's still an initial idea. So when you're first trying to learn how to read these markets, when you're first trying to determine where the market's likely to go, you have to strip away everything that you're trying to force into reading every single individual candlestick. And if you watch a lot of my videos, or if you have a lot of notes, or you've dabbled in things, chances are you probably already have a pet technique that you want to be yours. And you may not even be good at using it yet, but you just want it because it has a cool name, like a Reaper fair value guy. You know, when I taught that to my private mentorship, they're like, "Oh man, that's gonna be my thing. that's gonna be it for me." You know, or Event Horizon, which is the midpoint between two new week opening gaps or new day opening gaps, and because of the names, okay, these names are meaningful to me. They're not meant to inspire you to want to do them over another. It's just that's what I name them. I got 81 of these things, so it's a way for me to keep track of what its purpose was, and or it kind of puts a little stamp of when I discovered it and something had a impact on me and it was a cool name or inspiration to it. So when we're looking at price, as you as a brand new student not knowing what to do, you want to make this kind of like a game and a discovery, something fun, not a video game, okay, but it's a game of determining does it have what it takes to move to these highs here. A way of saying it to yourself that's very disarming. It's okay. I see how this is smooth. These two highs are relatively equal. That looks like a real nice, obvious flat space in price. We don't see that same flatness down here. You see that? So in other words, if you had a shark, if you had two sharks rather, you have two sharks in front of you. One has had its teeth removed. Well, that would be represented something like this. This is the shark with no teeth. It's basically got gums. Okay, there's no teeth there. Down here, there has been a shark attack. How do we know that? Because we can see the wounds from the teeth, the jaggedness, the jaggedness, the jaggedness, and now it's gone to another frenzy or feeding. Where is that? Well, we've just created one. We have this high here that's really close to this one. You see that? So you observe price action and you're looking for areas that look real smooth and safe, where they say peace and safety, sudden destruction comes upon them. Any time that you're looking at price action, and it doesn't matter what time frame you're looking at, okay? If you're looking at it through the lens of a second chart, sub 1 minute, or a weekly chart or a monthly chart or a quarterly chart where it's 3 months of data compressed in to make the candlesticks, it does not matter. This principle is always true. The market will go to an area of smoothness for the purpose of disrupting any orders that would be resting above or below it. We've already mentioned down here, let me show you. Now, don't be discouraged if you can't watch this stuff real time and see it or outline it in advance. It's okay for you to come home for work and look at your charts after the fact and go back and look at this and study it as if you have obviously the benefit of hindsight initially, but you don't want to stay in that very long. So you're going to have to procure yourself some instruments that will allow you to watch price action, not with market replay. Look, I am not a fan of market replay. I absolutely loathe it. I hate it. I can't stand it, and I wish it wasn't available. I wish it wasn't even available to any one of us, because it's a crutch that allows frauds to be able to sound like they're smart and teach something because it's already happened. If you can do it over live price action, not just once in a while, but continuously, and your audience or viewership can see this, then you have earned the right to have a voice. And then people should have no problem sitting and listening to you lecture and talk about what you think is likely to occur, because you have a sound basis or foundation to what it is that you're talking about. And therefore, because you have a track record of being able to talk about before it happens, it removes the anxiety that is reasonable for everyone to have when they first sit down and listen. But when you, as the student, and you don't have the ability to watch it live because you have a job or you're in university or you sleep, like you have to sleep, right? And your place in the world and your general geographic location may not be conducive for you to trade at 8:30 in the morning New York local time. You may have to trade in the London session. And yes, Virginia, I will be up during the London session doing one of these or two of these lectures in a week or two. Okay, so we're not focusing on one specific time of the day, and I'll come back to that section where I was telling you write down the times of the day in a moment. But when we're looking at it initially, you don't have to see this real time to get a collection of screenshots for your journal. But if you don't do this and journal and screenshot and annotate your chart and study how long price runs took place, how many candles did it take to move there, was there any kind of formation in the price delivery that would have caused you to not trust it unfolding. Now that's going to be very hard for you to do, because initially, especially the men, they're always going to say, no, I would have never second guessed it. It would have been easy for me to hold on to that. And these same people, when they get into a trade, if they ever were to do it in front of you, they don't have any conviction, and they're going to hurry up and bail out on the trade. Okay, I got to get out of this. I can't stand the pressure. It's moved 5 handles. But they call 30 handles or 50 handles above or below, and they get out of 5 handles because the pressure of it not doing what they expected to do, and in realizing a loss in front of someone, that's a lot more pressure for them, and they don't want to have that. So what's more important, their image or them following a model that they have seen works and have trusted and did the back testing and they have the data behind it? Their image. And that's not someone you should learn from. Okay, I'm just tossing that out there. So what we're looking for always, the first thing that you're looking for, Caleb, is where is the market smooth on the 15, the 5, and the 1 minute chart. Is that complicated? Nope, it's not complicated at all. It's real simple. What does it look like to be smooth? When you have price levels that create highs, like this swing high here and this swing high here, they're real close to one another. See that? When you're looking for relative equal highs, here's your secret weapon for it, okay? How do you know it's a high probability relative equal high that's likely to get swept or traded through? How do you know that, ICT? What differentiates that from any other? Okay, it's this. If you have two swing highs, if the one to the left is slightly higher than the right, you have a very, very high probability that they're going to want to take it above there. Just like you see here. We have a high, and then the swing here happens to be just a little bit lower than that one. Here's what's going on. This is called priming, okay? Priming is where you continuously create, inspire, or manipulate the expectations of a large number of investors. And they think, oh, it's going to go through that high. But then there's a lot of folks that don't want to see it go there because they went short. So when the market goes up here and stops and turns down, what that does is it creates a sympathetic sigh. The shorts are relaxing. If the shorts are relaxing, what are they saying? They're saying that this is now what? Resistance. So anyone that takes a new short position, where are they going to think that the safest place to put their stop loss is going to be? Right above these highs. Why can we trust that they're likely to take that relative equal high out? Not that it will that session that you're trading, but it's high probability that this will be swept when the second or the one to the right, that swing high is lower than the one to the left. That frames these two as relatively equal. Okay. Same thing is occurring here. We have this high here, this high here, this one being slightly lower than that one. So when the market went up like this and we had this drop down, what that causes is a sympathetic sigh. What is that causing people? Anyone that went short here, they feel like, okay, that's scary because it almost went to that high where their stop loss would be if they're trying to go short in this area. See that? So what do you think it looks like when we have relative equal lows? What would be a high probability relative equal low that the market is likely to draw down and go below? It would be a low that has a slightly higher low. In common terms, it's referred as a failure swing. Okay, so a failure swing. Now a lot of people say, "Oh, see, he's just reinventing." No, see what you're trying to trade that. That's what a failure swing is. When you're trying to trade, long or short on that second pass that doesn't take out the low or take out a previous high. That's selling short a failure swing. Okay. What I'm teaching you is how to identify in price action where the algorithm will refer back to and why. What are the central tenets as to what the algorithm is referring to at a specific time of day, most important. And then it refers back to these because, okay, it sees this high based on time, and then the high prior to that one is here. So it's very simple for the algorithm to call that information as an array and say, okay, this high was at this time, and this high was higher than prior to it. And they're in close proximity. What's the filter? I'm not going to tell you that, but it's not very much in terms of difference between the price. And when you have that element, the market will invariably start marching back to those levels. It does not matter. Listen, folks. It does not matter how many buyers are buying the market to go up there, and how many short sellers. Okay. The proof of it is just look at a depth of market. Look at a ladder. Okay, a dom, not a dome. Okay, I'm so tired of hearing people go. It's not a dome. Do you see an E at the end of that? It's DOM. It's a dom. Okay, depth of market. Look at those orders. There's no imbalances there. There's no imbalances. There's just as many short orders below the market as there is above. But yet the market will still march and march and march and march and go to the beat of the drum that I tell you it does. It reaches to these levels because it's coded to do this. And if you do this for a couple weeks, you're going to see, oh wow, yeah, this feels artificial. It feels like it's designed to do these types of things because it tends to repeat every single day at specific times of the day. It will do this. Now let me go back to the times element. Every day between 8 o'clock in the morning. This is always New York local time, okay? So it's very important you remember that because I have new people coming all the time, and they'll say, "I looked at this chart here, and you told me, yeah, but you're looking at it in Bangladesh time." Okay, I don't live in Bangladesh. I'm in the East Coast of the United States, and the algorithm is on New York local time. I don't care what anybody else tells you. Okay, that's what it's on. Period. End of story. You can wrestle with it if you want, but that's just the way it is. Between 8 o'clock and 8:30 in the morning, you want to sit down and determine where are the smooth locations in price action on the 15-minute, the 5-minute, and the 1-minute. Okay, and we've had the 15-minute on. Let's go down to a 5. Okay, so right away you can see that this high here is relative to that one, and this one here also with that. This one being slightly higher than that one. So there's a lot of liquidity that's sitting at 17,820.75. Now, real important, it does not mean that it has to happen during that session. It does not mean that. And that is the underlying risk that you assume every single time you take a trade. You're looking for things that are going to stack the odds of probability in your favor. It does not mean it's an absolute guaranteed outcome. See, I have students that literally take the time and waste their time in writing me an email. Sometimes they're like novels or novellas. And usually it's like 3 paragraphs of congratulating me and worship and whatever. And I don't like that. And usually when I get that kind of stuff, I immediately just push the email away. I don't want you looking up to me. I don't want you worshiping me. I'm not the greatest of all time. I'm not the GOAT. I'm not none of those things. I'm just a guy that has a whole bunch of information and experience, and I want to share it with you. And I want to see what you do with it. But these individuals will say, I need you to tell me how to make sure that I don't have this wrong. I only want to take this pattern. So how do I avoid taking losing trades with a inversion fair value gap or a mitigation block or the breaker? How do I know if it's a breaker or if it's a shift in market structure? Well, that's easy. You have to have a higher time frame premise and a directional draw where the market's going to go. And if you think it's going to go higher, when you see the market creating a short-term turn, um, well, I'll give you an example right here. We have the relative equal lows here, and the market drops. You see that? So this drop down here, every up close candle on this time frame, all of this right here, that is your breaker. The most sensitive candle or range is going to be the last up close candle. Look at it like this. That's this range low. And see where the body stopped right there? We wick through it, I'm not denying that, but the damage is always done by the wick. And the range high there. Oops, sorry. That is your bullish breaker. But the range here from that up close candle that starts all these consecutive up close candles, all of that is technically the bullish breaker. So the most sensitivity is going to be seen in that last up close candle. That is not supply and demand. That's not supply and demand zone. Sam Seidman would never, ever, ever refer to what I just said. Never, he would never do that. And he would never consider that anyway because we're cutting through candles. Because we're looking at what an algorithm is doing, not some floor trader ticket runner's perception of something that doesn't really exist. So the turn here at the bodies, that tells you what? It tells you the narrative. So what is it going to do? It's going to go higher. Okay, so what at that time would you focus on? Well, you have this short-term high here. The inefficiency that's traded to there. We want to see it trade above it and then act as what? Support. which would be a what? Inversion fair value gap. To do that, what would it reach for next? This high and this inefficiency. Does it do that? Yes. What are the bodies doing? Stopping just at that same level here. And more specifically, and my eyes didn't notice this when I put it up here. You see that little separation? That's a volume imbalance. Go back and listen to the other lectures. You have to include that volume imbalance when you have a fair value gap, whether it be BISI or CIVI. I don't know, put it on there. You go. And you can see the bodies being encapsulated by that. And now the market trades back up into that. The bodies candlesticks are trading inside the inefficiency. It wicks above it, but look where the bodies are stopping. And look where the bodies are over here. Where's liquidity at? Below here. Nothing in here. This is all very balanced price delivery because it's back and forth. Every other candle is overlapping the highest high and the lowest low, pretty much kind of like coloring it very, very, very good. Back and forth. All this price action is back and forth versus then we have all these run where we have separations in here, back down into that breaker there. This response right here to what it's just done there, that expectation and response in how price can react to levels like that, that's a nice little scalp right there. I mean, look at it. It moved from 515 to what? 596. That's a good run. You can't get 20 handles out of that on a 15-second chart. You can if you know what you're looking for. Now also notice that we've created again high, lower high, high, lower high, but real close to one another. When did it form? Prior to 9:30. So we have 8 to 8:30, and then you study 9 to 9:30 because it's going to do what? It's going to look and seek the liquidity or inefficiencies. So here's 9:30 right there, forming on the bullish breaker. It trades down, and then we have relative equal highs here. I don't like to usually do this, but I have to do it for the sake of discussion. So we have these relative equal highs, this high and that high, relative equal high, and we have this area up here. So if the market's going to do what? If it's going to make a punishing move towards the shorts that want to see it drop because the market has dropped early on, 7 o'clock in the morning, okay? And we have all these very clean levels. What did we just do here? We have a low. It was traded down into. It disrupted this little area in here. So it's made this area jagged. Remember I was saying earlier where the market's real smooth over here versus what it was doing down here. Where has the work been done? Meaning, if there is a group of traders that are very cannibalistic and they tend to be more correct than wrong, or if they are the ones that generally make the money more consistently than the ones that don't. In other words, think of like the World Series of Poker. Okay, if you ever watched that, it's really fascinating to see how the long-term players that always find themselves at the final table. They may not win, but they always find their way at the final table. That's experience and that's skill. Well, you can see those things in price action. They're like fingerprints, okay? You can see when the cannibals come in and they devour the pygmies. They go in there and just chew them all up. And it's where the market is made jagged price delivery. Always. It's always like this, folks. It's never not going to be hidden from you, okay? It's always plain sight. But see, you're so enamored by animal patterns, harmonic patterns, gimmicky named supposed retail indicators. Everybody's got a new indicator. I got one for you that's going to beat all of them. It's the open, high, low, and close, and the clock. How about that? How about that? Catch me outside. How about that? Okay. It's simple. And all of you complain, not all of you, but just the asshats do. Oh, this is complicated. This is convoluted. So and so teaches this so much better. Okay, I don't see so and so doing anything. I don't see so and so doing anything but using market replay.